Welcome to the Accredited Investor. I'm Scott Smith, and I'm joined by Bryan Smith. On this channel, we explore ideas, structures, and long-term thinking that shape private markets and family wealth and alternative investments, always with an education-first approach. Today, we're going to talk about institutions and private markets. Institutions have used private markets for decades. Endowments, pensions, and foundations, they think in generations, not just in quarters. Their use of private markets is intentional. But this isn't about, of course, copying institutions, but it is about understanding the framework they use. In other words, long-term thinkers naturally look beyond public markets to private markets in order to make sure that their time frames are met. There are limits to public markets. Public markets are valuable, and we're not dismissing them, but they come with real constraints. Daily liquidity, increased correlation during stress. In other words, when markets go down in the public markets, stocks and bonds tend to all go down together. And of course, there's fewer public companies than in the past. There aren't as many IPOs nowadays as there used to be. Companies are staying private for a much longer period of time. So really, public markets don't always reflect the full economy anymore. They're important, but it's kind of an incomplete picture. When we're talking about public and private markets, we want to blend them together because we understand and we believe that diversification is important not only for our clients, but for the investments that they have. So, Bryan, why don't you talk a little bit about diversification, if you will.
Yeah, I think it's important that people understand diversification isn't just about owning more investments, right? Often we talk to our clients about the importance of diversification is every dog has its day, right? There's a part of the market that's doing well. There's a part of the market that's not doing well. Hopefully, if you have the correct allocation and diversification, you end through the rest of the year with a nice, strong rate of return. Mm-hmm. So really, private markets kind of behave a little bit differently than maybe your typical markets. It gives them a diversification for when public markets are having a bad day, private markets maybe lift up their portfolio. When we talk about diversification in the private markets, we're really talking about three main categories, at least the ones that we focus on. The first one's going to be private credit. The next one's going to be real assets. And then finally, we round it all out with private equity. So let me kind of dig a little bit deeper into each one of those. So private credit is this idea of organizations going to a private lender and getting money to maybe expand or grow, hire more people.
Kind of outside the traditional market.
Yeah,
outside traditional banks.
That's exactly right. So as legislation and restrictions on lending practices have evolved and changed, it has really opened up an opportunity for another lending area. It's really turned into one of the largest lending areas out there. And it allows businesses to maybe take a different thought process of growth. The other thing is real assets. These are those tangible things that we can all touch and grab, just access to them. Finally, we have private equity. At one point, all companies were private, right? It wasn't until the 30s and 40s that we started making the ability to own companies publicly more acceptable. So this is going back to that old school thought process of being part of a business back when maybe it's being founded or it's just starting or revolutionary, right? Allows you to get in when the excitement is new, and maybe they'll go public. Maybe they'll just continue to stay a private company, but gives you the ability to maybe get access to things that aren't readily available to everybody else. But access comes with, I think, a really, really important thing, which is liquidity. Right? Or illiquidity for our conversations. Yeah. Mm-hmm. You want to kind of touch on what we look at, maybe the positive and negative side of liquidity?
Yeah, sure. So it's interesting. Illiquidity has value, right? The process of not being able to get to your money over a period of time provides the thought that if there is that illiquidity process, that you should be able to get maybe a better rate of return over a longer period of time. That's kind of the idea of the illiquidity premium. It's not guaranteed. And of course, it's not appropriate for all capital. But if you take a look at it, institutions, they plan for illiquidity. They want to make sure that if they're going to put investments into a portfolio that has a longer time frame because it's illiquid, that they plan for whatever cash flow needs they need. Unfortunately, individuals often underestimate it. It's part of that process of making sure that your clients understand these private markets are and how they function to make sure that they plan for and as we talked about illiquidity, we talk about that process of a longer time frame, right?
Right.
Talk a little bit about what that means.
This is a really, really hard topic because today we want everything instantly. Instant coffee, trades, buys and sells. But really what this comes down to is private markets require patience. Every good thing is worth waiting for. So it's important for people to understand that they're not tradable here today, gone tomorrow. Buy in today, sell half hour later like we may be used to and have a lot of conversations about. We want to make sure that we're moving into an investment that fits where they want to go with the long-term expectation, and know that with these time horizons and cash flow needs are very relevant in this conversation. What I mean by that is you may invest in an asset and not be able to get money out of it for a couple of years. Remember, you're investing into a asset that is taking this money and immediately using it, right? We're not just buying and selling stocks. We're buying into this actual business, or we're funding this growth of this business. With that, it creates this need for time horizons or options to get this money out. And that comes into educating our clients, because we're talking about investments that kind of change that thought process of life. We're going to spend a lot of time in this Accredited Investor series and on our website and talk about longevity, talk about generational wealth, talk about planning out for multi-decades, multi-generations of return. And that comes with that education conversation, Scott. So why don't you talk to our clients a little bit about how we educate our clients, or the importance of education of these types of investments?
Yeah, that's exactly right. As Brian said, we talk about longevity planning because we're all going to live longer. And we want to make sure that not only as we live longer, our investments are actually situated, if you will, for that longevity. But we also want to make sure that our investments are positioned for, like you said, multi-generational wealth, that transition of wealth down through the generations. And that's important to understand, because if we don't do it correctly, if we don't educate our clients correctly, complexity demands understanding. And we want to make sure that our clients understand structures, timelines, and risk. Risk matters, right? So education reduces mistakes. That's why this channel exists. So, our philosophy at PastWorks is simple. Slow the process down so decisions are made with clarity. We want you to learn more about the site if you're interested. The website that we have, which is www.theaccreditedinvestor.com, kind of expands on these concepts. It's built for accredited investors who want clarity before decisions. No pressure, no product push, just a place to keep learning. So we want to thank you for watching. If you'd like to go deeper, visit us at our website, where we share additional education and resources for accredited investors. And if this conversation was helpful, subscribe here on YouTube. We'll be publishing more content like this right here. Thanks.
See you next time.